Here is what no one in mainstream finance will say out loud. The system that prices your savings, your wages, your grocery bill, and your energy costs is not broken. It is functioning exactly as it was quietly redesigned to function. And the people running it are not confused. They know the numbers. They simply prefer that you do not. Welcome to Silver Dispatch. I'm OG Peter, and today we are going through the tape together, not the edited version, the raw version. On the morning of May 12, 2026, the Bureau of Labor Statistics published the April Consumer Price Index. Headline inflation clocked in at 0.6% for the single month and 3.8% on a trailing 12-month basis. That is the hottest annual print this economy has seen since May 2023. Core inflation, with food and energy stripped out, held at 2.8% year-on-year. Both readings came in above the Dow Jones consensus. Both surprised to the upside. Now, here is where it gets interesting. Buried inside the technical appendix of that same report, written in the kind of dry, bureaucratic language governments favor precisely because it discourages most people from reading it, was a single figure that deserves far more attention than it received. Real average hourly wages declined 0.5% in April alone. On a trailing 12-month basis, the average American worker is now down 0.3% in real purchasing power. That is not a projection. That is not a podcast theory. That is the federal government's own ledger, formally published in writing. The purchasing power of labor is declining while the cost of energy is accelerating. The Bureau of Labor Statistics confirmed that the energy index rose 3.8% in April alone, accounting for more than 40% of the total monthly increase. Gasoline is up 28.4% year-on-year. Fuel oil is up 54.3%. Airline fares are up 20.7% over the same period. These figures are not anomalies. They trace directly to a choke point in the global energy trade that has been effectively closed since late February, the Strait of Hormuz, through which, before the current conflict, roughly 1/5 of the world's daily traded oil moved. West Texas Intermediate settled above $102 per barrel. Brent crude closed at $107.77. The U.S. Energy Information Administration, in its May short-term energy outlook released the same morning as the CPI, assessed that the strait remains closed, global inventories are drawing at 8.5 million barrels per day, and that Brent prices will hold near $106 through the end of June. This is the environment that silver is navigating at $84.53 per ounce right now. Pay attention to that number. We'll come back to it. Let me show you the structure beneath the surface, because this is where the real story lives, and it is one that the mainstream financial conversation has neither the patience nor the incentive to walk through properly. The Silver Institute, the industry's own primary research authority, released its World Silver Survey 2026 on April 15th. And the phrase they chose to describe the current market condition was not optimistic hedging. They wrote directly that silver has entered an era of reduced stocks. 6 consecutive annual supply deficits since 2021. A cumulative drawdown of 762.1 million ounces from global above-ground commercial and investment inventories over 5 years. The 2026 projected shortfall alone stands at 46.3 million ounces. That is not a blip. That is a sustained compounding depletion cycle. However, the more revealing data point sits inside the London Bullion Market Association vault disclosures from October 2025. Total silver holdings at that time stood near 884 million ounces. But per Metals Focus commentary cited directly in the Silver Institute survey, only approximately 150 million ounces, roughly 17% of the total, was operationally free for delivery. The remainder was leased, allocated, pledged, or otherwise encumbered. When industrial demand tightened against that thin free float, the one-month London silver lease rate moved from 1% to over 30% within weeks. That is a market that briefly lost structural footing, caught itself, and climbed back, while every underlying condition that caused the near failure remained entirely in place. Now consider supply. Global mine output is projected at 844.1 million ounces in 2026, essentially unchanged from 2025, despite silver averaging over $40 per ounce last year. A 42% annual price increase that, under conventional economic reasoning, should have incentivized a meaningful production surge. It did not. The reason is structural. Approximately 74% of global silver production is extracted as a byproduct of copper, lead, and zinc operations. Silver-specific price signals do not redirect base metal mine development calendars on any useful time horizon. But there is a catch that has not yet been priced into the tape. On May 11th, Peru, the second largest silver-producing nation on the planet, responsible for roughly 13.6% of global mine output, issued a formal national energy emergency decree. The decree directly impacts mining operations, mineral processing, and logistics across the country's entire upstream mining stack. Peru holds among the largest documented silver reserves on Earth. A national energy emergency arriving on top of a structural supply cycle that was already in deficit is not a marginal development. It is a fracture stacked on a fracture, and the market has not yet assigned that event the weight it deserves. This is where it gets genuinely consequential, because the supply architecture we just walked through does not exist in isolation. It is colliding in real time with a set of monetary, geopolitical, and institutional forces that are arriving simultaneously, not sequentially. Within 60 minutes of the 8:30 CPI release on May 12th, CME Group's FedWatch tool showed the implied probability of a Federal Reserve rate hike by year-end 2026 rising to approximately 30%. Futures traders are now pricing over a 70% probability of a rate hike by April 2027 and have fully removed any expectation of rate cuts through the remainder of this calendar year. The 10-year Treasury yield rose to 4.45% following the print. The US dollar index strengthened. I will be direct with you here, because Silver Dispatch does not manage your expectations. It informs them. A strengthening dollar and a rising rate environment represent real headwinds for non-yielding assets, and silver is a non-yielding asset. That is the honest framing. Anyone presenting the bullish case without acknowledging this is doing you a disservice. However, and this is the part the orthodox framework consistently misses, the Federal Reserve's rate trajectory is now converging with a leadership transition that carries its own consequences. On May 11th, the U.S. Senate voted 49-44 to advance Kevin Warsh's nomination to the Federal Reserve Board of Governors. A confirmation vote to install Warsh as successor to Jerome Powell is expected before Powell's chairmanship formally expires May 15th. Warsh's record is not ambiguous. He dissented against quantitative easing during his prior board tenure. His posture toward accommodation is structurally skeptical. If the Fed's next move is tighter, not looser, it validates the monetary case for hard assets with a precision that years of accommodative policy never could. Paradoxically, the hawkish confirmation strengthens the argument for owning something that governments cannot print. Then there is Beijing. President Trump arrives in China on May 13th for a bilateral summit on the 14th and 15th, carrying the hottest inflation print in 3 years, a Hormuz ceasefire that the president himself described as on massive life support, and a trade agenda that includes rare earths, Taiwan, Iran, and artificial intelligence. China is, by any serious accounting, the dominant physical player in the global silver market. Its rare earth export leverage, deployed last year when American tariff levels briefly crossed 140%, remains fully intact. The Council on Foreign Relations has confirmed that China has already positioned itself as the primary mediator in the Iran-Hormuz situation. The party entering that summit holding physical inventory, upstream reagent leverage, and the Iran mediator card is not negotiating from weakness. What emerges from those rooms will move markets in ways that no published consensus forecast has modeled. Before I close, intellectual honesty requires that we look at the bear case directly, because the data that challenges the bullish narrative is real, and dismissing it without engagement is not analysis. It is theater. Silver at $84.53 on May 13th sits approximately 30% below its all-time intraday high of $121.67 printed on January 29th of this year. The Reuters poll consensus for the 2026 average silver price is $70.50 per ounce, already below current spot. JP Morgan's full-year 2026 average target is $81 per ounce. Bloomberg NEF places 2026 solar sector silver consumption at 194 million ounces, a 7% year-on-year decline as manufacturers continue reducing silver content per panel. The iShares Silver Trust, despite a 162.63% trailing 12-month return, recorded 3-month net outflows of $2.82 billion. The Atlanta Fed's GDP Now tracker estimates second quarter U.S. growth at 3.7%, not a recessionary backdrop. These are legitimate coordinates. A disciplined observer weighs them. Now weigh them against this. The Sprott Physical Silver Trust currently holds 216 and 233,101 ounces of fully allocated, unencumbered London Good Delivery silver stored in Royal Canadian Mint vaults. Coin and bar demand for 2026 is forecast to rise 18% to 227 million ounces, a 3-year high. Russia has formally incorporated silver into its sovereign precious metals reserve program, the first major central bank reclassification of silver in modern monetary history. The World Gold Council's 2025 survey showed 95% of central banks expect global gold reserves to rise in 2026. When institutional capital moves in a direction, it moves in volume across years, not quarters. And Bank of America's published 2026 silver target architecture places the upper bound at $309 per ounce, roughly 265% above where silver trades this morning. These are not the coordinates of a market that is already priced in what is happening. These are the coordinates of a market that is still completing the arithmetic. George Santayana observed that those who cannot recall the past are condemned to relive it. The Hunt episode of 1980, the 2011 spike to 48 out 70, the October 2025 London lease rate squeeze from 1% to 30% in a matter of weeks, each episode shared the same architecture. Supply thinner than it appeared, demand larger than consensus expected. A price response that arrived faster than any model predicted. The data on the tape today, 84.53 silver, 4,713 gold, 3.8% CPI, Peru in a declared energy emergency, a 6-year structural supply deficit, a new Fed chair confirmed, and a Beijing Summit underway, is not noise. It is signal, dense, cross-corroborated primary source signal. I'm OG Peter. This is Silver Dispatch. Drop a comment below. Which fracture do you believe the market has most severely underpriced? The discussion in the comments is where the real thinking happens. This is for education and analysis only, not personal financial advice. Do your own research. Manage your own risk.